Your mutual funds is in red. News is shouting war.
Iran war. Iran war.
In the war with Iran.
Crash. Foreign investors selling. Should you panic, stop your SIPs, or buy more? In the next 5 minutes, I'll give you a simple plan so that you can handle this wartime volatility to invest smarter for the next 10 years. First, let's actually understand what's happening. There's a war between the US, Israel, and Iran. This has pushed oil prices up globally and shaken global markets. Now, high oil price is bad for India because we import a lot of our oil. This not only hurts the rupee, but also adds to our inflation. As a result of this, foreign investors start to pull money out of the Indian markets, which contributes even more to the market fall. History shows that markets usually fall during wars, but later recover once things settle. After the Kargil War, COVID, and other global crises, the Sensex eventually made new highs. The problem is not the war headline, it's about how we react to it. Now, if you're an investor trying to navigate through these challenging times, here's a simple 3-rule framework that you can use for smarter investment decisions. Rule number 1, keep at least 6 to 12 months of expenses either in your bank FD, liquid funds, or as savings. Now, the reason for this is because it acts as a safety net so that you're never forced to sell your equities at the bottom. Rule number 2. These are your core long-term investments. This includes your equity mutual funds, your index funds, and your strong large and mid-cap stocks that are linked to your 5 to 10-year core horizons. Now, the most important thing to remember here is to not touch them because of war headlines. You need to continue your SIPs. Rule number 3. This is your bucket of opportunity. Segregate 10 to 20% of your equity allocation for staggered buying every time the market falls because of this war and foreign investors selling. Now, a simple rule of thumb to remember over here is this segregated allocation should be divided into 4 to 6 parts and invest each part every time the market falls 3 to 5% during this war. Now that I've told you what you need to do as an investor during this war, here are a few things you should avoid. First, stopping your SIPs because your portfolio looks temporarily negative. Next, putting all your money into war stocks such as defense or gold just because they're in the news. And third, taking extra leverage or undertaking intraday trades when volatility is very high. Be cautious of sectors that are hit extremely hard because of this oil crisis and be more open to exporters such as IT, pharma, and even manufacturing because they benefit from a weaker rupee. Also, you can feel free to look into quality banks or NBFC stocks and funds or even energy with strong balance sheets. Last but not the least, have a checklist that asks you the following questions. First, do I have my 6 to 12 months safety net? Second, are my SIPs continuing? Third, how much money am I going to put into my opportunity bucket and in how many parts? Fourth, am I just reacting to headlines or am I following a structured plan that will help me achieve my long-term goals? If the answer to all these questions look right, then don't worry, you're doing a good job as an investor. But if you would like to better know how to invest during this time, click the link below and our team of financial advisors will get in touch with you immediately to give you the best investment strategy.